Hello, everyone. A very warm welcome to those that have joined the webinar already. We are expecting quite a few more attendees from different parts of the world, from different countries today. So as I allow a little bit more time for those to join, I'll just run through some of the key housekeeping before we kick things off. So to start, your lines are muted and your cameras are turned off. If you do have any questions, you'll see in the control panel that you can submit them, and we'll try and get through as many of them as possible, especially in the Q&A section at the end. To answer a common question that we usually get, yes, the webinar is being recorded, and yes, we will be sending out the recording once the webinar is finished. Also, you'll see there's a resources tab on the control panel as well, and in there we'll be posting some useful links. So in the links section of the resources tab, you'll have access to our full report, which is what we're presenting today, and also a link to sign up to our other research, our daily and monthly reports as well. So today, the webinar is slightly different from what you're used to in our monthly webinar series, where we present our monthly report. Today, we're presenting our annual report. Are you ready for 2024? As you can see here. And the speakers today include myself. I'm George Vesey, the lead FX strategist. I'm based in the UK, and I'll be facilitating today's webinar as well. And then we have Boris Kovacevic, our global macro strategist. He's based in Austria. And in terms of the agenda, as you could see, it's relatively straightforward. I'll be kicking off with some customer insights to start off with, looking at some of the macroeconomic or broader business issues that our customers are facing. And then we'll head into the 2024 global market outlook, which Boris will start with, looking at what are the key trends that are driving volatility trends in 2024. Then we'll discuss some of the regional outlooks, so looking particularly at the US, Europe, and the UK, and that will lead us into our FX forecasts as well, the currency analysis that we're all here for as well. At the end, I'll touch on some FX risk management trends that we've been analysing as well before we finish up with the Q&A section, as I said. So from here, we're actually going to turn our cameras off. That will allow you to just focus on the webinar slides, because there's a lot of content to digest here. So hopefully that should help. Before we do move forward, I just want to take a brief look back at what our customers have been telling us, because as always, businesses like yours trading internationally have to continue to deal with all these cross-border frictions like supply chain pressures, any unexpected input costs, new policies, and of course, unexpected spikes in currency volatility. And what's been interesting this year is that we've actually experienced historically low levels of FX volatility, especially compared to the previous couple of years. But the macro environment and the market climate as a whole, it certainly hasn't been dull. We have seen a lot of volatility in other financial markets for sure, and that has influenced the trends we've seen in FX this year. We've still had some surprises, of course, creating headwinds for many businesses, I'm sure. And obviously, inflation rates, they have been falling, but they remain historically elevated, well above central banks' targets. And of course, if you remember, we had that banking turmoil early this year that rattled financial markets. And yet still, central banks continue to raise interest rates to try and tame those price pressures. But it's also been in response to some resilient economies that we've seen this year. Particularly, that's been the case in the US, but also in the UK, where we haven't seen the protracted recession that was expected. Europe as a whole, bit of a different story. Germany really suffering, but Boris will cover that in more detail shortly. Ultimately here, what we want to highlight is on this particular slide is what you told us, and that is that high interest rates and inflation remain the most pressing macroeconomic issue for businesses around the world. As you can see on this chart as well, cash flow and credit conditions, as well as geopolitical and trade risks, were chosen as key concerns by almost half the respondents too. And as we know, the geopolitical landscape in particular, that's becoming more and more unsettled. And in fact, our partners at Oxford Economics, they released their Q4 Global Risk Survey results this week, and that revealed geopolitical tensions as the top business concern in terms of the impact on the global economy. And that was followed by high interest rates and sustained weakness in China. So with all this in mind, to help provide some forward guidance on some of these key global macro topics or themes for next year, Are You Ready for 2024 report delves into these issues that you told us about, that you're most concerned about, but also some other emerging trends and events that we think will continue, have already, and will continue influencing exchange rate volatility and cross-border trade in the future. So today we're presenting a few of those key themes, but remember, you've got access to download the full report in the resources tab on the control panel. I'll hand you over to Boris now, our global macro strategist, who's going to start us off with the global market themes. Over to you, Boris.
Well, thank you very much, George, for the lovely introduction, but also for, again, presenting the client insights, because what I would like to do next is to actually build on these topics that you have been discussing. We know from experience, we know from these internal surveys that our clients and international businesses in general are, looking at these themes not only from a macro perspective, like we are, but also from a risk management and hedging perspective. But these topics have also been, as we will see, major volatility drivers over the past few years. And this is why, as you mentioned, we have prepared 3 of our 5 global topics, corresponding each to 3 specific calls, or let's call them forecasts, for what we are expecting for 2024. I will start with our views on the global economy and monetary policy, and also have a look at the implications of all of it on financial markets. And then George will conclude with the recent developments surrounding international trade and geopolitics. And again, just briefly before we go to this slide, the goal of this section is not only to give us a better understanding of why these topics are so important, but also to build a base for understanding our FX forecasts that George will be presenting afterwards. So with that outline in mind, we can already turn to this first page of ours, in which again we try to put forth our views on not only the global economy, but also monetary policy from a European perspective. And it is really probably the most important and the most difficult call to make in any year ahead outlook, not only in any year, but also given how unique the post-pandemic period has really been. So just to put a bit of context surrounding our 2024 call. Going into this year, we have seen central banks worldwide increasing their interest rates by more than 500 times over the last 2 years. And at the same time, they've also slightly decreased the liquidity they have been providing to markets. In this drastic double shift from central banks, from something that we have called the easy monetary policy regime that has governed markets for pretty much well over a decade since the global financial crisis, since to the pandemic, to such a high interest rate regime that we are currently facing, has really left its mark on global economic activity. And this is why the global economy has already entered what we would describe as a pro-cyclical recession, meaning that while global growth in general has still been positive over the last couple of months, all the pro-cyclical and interest rate sensitive parts of the real economy are already contracting. Think about the manufacturing sector, global trade, the property market. They've all been in a recession for quite some time in most countries we have looked at. Mortgage rates, for example, have risen quite substantially to the highest level since the global financial crisis in Australia, in Japan, in Europe, and they've already reached 20-year highs in the UK and in the US. And this, in our belief, has put quite some pressure on the construction sector, on property prices, and on existing home sales. Turning to global manufacturing and world trade, they've both been negative for quite some time. Global trade has been contracting since April of this year. And our 2 calls for 2024 in this slide come against the backdrop of this weakening of the economic cycle. So economic growth will, in our opinion, continue to be quite weak, especially going into the next 2 or 3 quarters, under the assumption that the US starts to slow down a bit and we start feeling this lagged effect of these high interest rates. So again, the next 2 or 3 quarters will probably be characterized by weak economic growth, especially as we are expecting the global consumer to spend less going into the winter season and unemployment rates to start going up. And I think all this that I've mentioned kind of culminates into our forecast that we can see in the first sentence, meaning that we are expecting real GDP growth on a global basis to be less than 2% in 2024. And this sub 2% growth will be the first time the global economy is not expanding more than 2% in a year outside of a crisis year, meaning outside the global financial crisis in 2009 and the pandemic era of 2020. However, just to put a slight bright note on it as much as I can, we are expecting inflation to come down quicker than markets are currently expecting in most countries. And this, I think, solidifies our view that all three of our G3 central banks, the Bank of England, the European Central Bank, and the Federal Reserve, are trying or will try to cut rates going into next year. And given this monetary easing, and of course under the assumption that inflation doesn't surprise to the upside like it has last year and this year, the second half of 2024 could see a slight revamp of these pro-cyclical sectors that have been hit so hard this year. We also need to keep in mind that the global outlook is important. It is important to look at the economy from a global perspective, but it is not nuanced enough on its own to just make an immediate FX call, as we will see later on. Because within this global trend, we have regional divergences. This is why, for example, we expect, like we see in the chart, a slight European recovery, while we expect weaker US growth. And is it also why we expect, for example, the central bank in Australia to cut rates much later than our G3 central banks. So these divergences, I think, will be where volatility really comes from going into 2024. So with this in mind, I think we can already start looking at the implications of this global view on financial markets on the next slide. Once again, I like to put the recent movements and the recent volatility a bit into perspective and into its historic context. So looking at global stock markets, they've pretty much been moving sideways ever since the beginning of last year. And this doesn't mean that we didn't have any volatility, as George mentioned. On the contrary, but in general, we could definitely draw a flat trend line over most stock benchmarks over the last couple of months. We did, however, go through some very interesting phases that are important to note to understand where we are going into 2024. So between January and October of last year, most leading indicators in the UK, in Germany, in the US have been falling quite substantially, mainly because of the war in the Ukraine, because of the lagged effect of higher interest rates, because of the energy crisis in Europe, and because inflation was still really high. And this, in October, we kind of hit the peak of this pessimism wave. Since October, stocks have been trying to recover, and this recovery lasted till mid-July this year. And since then, again, we have seen a bit of pessimism leaking in again. We have seen stocks fall and bonds rising once again. But these three phases that stocks have been going through from January to October, from October to this July, and then from July onwards, we didn't really see this in every market, and especially not in the bond market, because the price of government bonds, of company bonds, has fallen significantly and consistently since the beginning of the central bank's tightening cycle at the beginning of 2022. Because as the bond prices naturally have an inverse relationship with the yield, it means that every time central banks start raising interest rates, yield rise, and the price of an existing bond falls. And as George mentioned in the beginning, these interest rates have been so drastic in recent years that US bonds actually fell by 50%. So US bonds on the long end, 10-year, 30-year treasuries have lost around 50% of their value, which is the largest yearly loss in value since 1976. And to just put a note on it, there have only been 4 years in which both stocks and bonds have been falling, and one of them has been 2022. And also this year, the decline of bonds has continued. And because of this extreme move and just the fact that we believe that all major central banks are done raising interest rates, we see bonds as really a good investment for the first time in probably 3.5 years. And in this chart here, we try to show how different asset classes have historically behaved once the Fed had ended its tightening cycle. And we can clearly see that the median performance of our G7 bond index 250 days out meaning 250 days after the Fed has stopped tightening, has been a solid 5.9%. So with yields falling, or expected to fall, it also does make sense to see equities start rising again. And we can clearly see this historically with an overperformance of 16.6% after the point that the Fed stopped hiking rates. But it's not that simple of a forecast going into 2024, because if we start to differentiate the analysis a bit more and look at the stock market performance, not only after the Fed pauses its rate cycle, but also look at periods where the US fell into recession after it or not, we can clearly see that once the US falls into recession, the short-term pessimism kind of overtakes or overshadows the optimism around the Fed being done hiking rates. And given that we are expecting an economic slowdown in the US, our forecast, or our normally bullish forecast on US stocks or global stocks in general, has been a bit dampened, and we are more cautious, especially going into 2024, the first half. Looking at the second half, we are seeing again a slight rebound of the pro-cyclical part of the global economy, with central banks starting to cut interest rates. And this, I think, would be a good time then to look at these pro-cyclical and risk-prone assets. But yeah, I think that's pretty much from our side. We have to keep in mind, just a last sentence from my side here, we have to keep in mind that all these assumptions we are making and all the forecasts are still really limited by all the trade and geopolitical tensions that are currently in place. And this is something we have to note. And I think George can definitely give us a better outlook on why this is so important going forward for markets.
Yeah, thanks, Boris. Just before I move on to this slide, as well as a reminder, we do have more global themes that we cover in the report, covering such topics as credit conditions, political events, like the several elections that we've got next year as well. And that obviously brings a lot of uncertainty with regards to future policy and the impact on financial markets. But in the interest of time today, I'll repeat that we aren't covering all of that. But again, you can access the report, download the report, and talk and look into that in more detail. But this theme here is in relation to trade, but also goes into geopolitics a little bit, because trade disputes, government policies aimed at reducing reliance on a particular source market, they have consequences for longer-term balance of trade and payments, and a material change in the balance of payments between two countries that can cause some FX volatility as well, and potentially alter long-term currency trends, which is why we wanted to share with you this particular theme today. Now, monetary tightening has had and it's going to continue having an impact on global trade by reducing demand, and global credit is also shrinking as well, threatening trade financing. But the good news is that we have seen that supply chain conditions have normalized, freight costs have dropped, energy prices, especially gas prices, they've been volatile again this year, but they have fallen significantly from the peaks. So despite all of the pandemic-related disruption and the monetary and credit tightening that we've witnessed over the last few years, actually the value of cross-border trade grew by 24% between 2019 and 2022. So that's actually a lot stronger than the long-run average of around 6% per year since 1995, according to some data from the World Trade Organization. But what we want to really highlight in this theme, though, is how important it is to take stock of the current geopolitical and trade climate and consider how, as a business, you might be able to stay ahead of the curve. And a clear example of this is, recently has been the diversification away from China, the so-called China Plus One strategy that encourages companies to minimize their supply chain dependency on China by diversifying the countries that they source from. And this strategy certainly accelerated over the pandemic due to lockdowns, the factories closing in China, freight travel delays, and interestingly, from a UK perspective, pessimism amongst those British companies operating in China is at a record high. Almost 90% of the companies polled by the British Chamber of Commerce in China saying that it's become more difficult to operate there over the past 12 months, compared with 67% in 2020. And even in Germany, another study by PwC found that although 88% of respondents still see China as an important partner and an important economic partner for the future, 77% consider alternative and additional locations to be vital, and more than a third of those already have some contingency strategies in place in the event of a crisis. So, you know, with all the geopolitical tensions that are growing, this strategy of de-risking supply chains is becoming more popular. And as you can see here, we've identified one example of an evolving pattern of trade as a result, which is that Mexico has overtaken China as the largest overseas source market for US imports of goods. So in layman's terms, America's biggest supplier of foreign-made goods and services is now Mexico, and China had held that an official title since 2008. So now that's Mexico. And interestingly, but perhaps unsurprisingly, here at Convera, we're hearing that more of our customers in the US are becoming increasingly exposed to the Mexican peso as a result. They're interested to hear about analysis on the peso, and that the peso has actually strengthened to 7-year highs this year. So a lot to talk about there, a lot to consider from a business perspective. And on the flip side, this global diversification of trade away from China could be one of the key factors behind China's currency depreciating over the past 12 or 18 months. And granted, China has been easing policy, so against the grain of the wider advanced economies that have been tightening monetary policy, of course, that would have resulted in depreciation of the Chinese currency as well. But the fall in demand for Chinese exports is likely to be contributing to the depreciation of the currency as well. Now, obviously, we understand that diversifying away from China or nearshoring trade isn't something that every country or every organization is going to find easy to do, given the different dependencies and even different policies that are involved. But if possible, we do see it as a really important consideration for businesses in the future, not least because we're seeing governments using trade more and more to achieve geopolitical aims. So who knows what the future holds in that respect? Therefore, spending some time and looking into how to possibly de-risk your supply chain ahead of any escalating global trade wars could be a pivotal move for the future. So that's a flavour of some of the key global themes that we picked out for next year. We're now going to move on to our regional outlooks. As we mentioned at the start, we'll be covering the US, Europe, and the UK. And we'll be kicking off now with the US, and I'll hand you back to Boris, who's going to walk us through that. Cheers, Boris.
Amazing. Thanks, George. Yeah, looking at the US, I think it is important for us to, first understand what has really been driving the strength of the US economy over the past few years, especially versus its developed market peers. Because we have noted several times in our report and also during the presentation that these post-pandemic factors, labor market shortages, excess demand, high savings rate, they're still shaping the US economy 3 years after the pandemic. And they're shaping the US economy to such an extent that some have called the US exceptional in terms of how it has been resilient in the face of these higher interest rates, especially compared to its peers in Europe, which might be one reason that we lay out for the unusually large disconnect between the strong lagging data and the weak leading economic data at the moment. Because while most of our recession indicators for the US have been deteriorating at a worrying pace over the last 6 to 12 months, hard and lagging data like industrial production, consumer spending, retail sales, but also GDP in general, looking at the latest growth number for Q3 in the US, they have still been quite resilient. And this is something we have tried to highlight in this chart right here, because the 20% rise in nominal household income since the pandemic has really rippled through the whole economy in general. So we can see imports have been rising by 22%, spending has risen 26%, retail sales 32%, and good spending, which is kind of exemplary of how the pandemic changed the demand on the consumer side, has increased by 46%. And this is why forecasting a recession, like everyone has for the past few years, has really been a lost cause in the US. Strong consumer spending, as we see here, a robust labor market have really pushed out the recession calls in the last couple of weeks and have put the possibility of a soft landing, meaning the US avoiding a recession, back on the table for 2024. At the same time, I would have to note that we remain a bit more cautious regarding the US economic outlook, just because with the free US stimulus checks from 2020 and 2021 being mostly depleted, because total savings have returned to pre-pandemic levels, spending in the US may definitely face some headwinds in the next quarters ahead, especially because of the US labor market expected to weaken in the months ahead. We can see that short-term interest rates are at 20-year highs in the US, and they are slowly but surely starting to work their way through the economy. And this is why we are expecting economic momentum to be a bit weaker going into Q4 and especially Q1 next year. At the same time, we can also see that both the manufacturing and the property sector have been in a recession for quite some time. This is why after a blockbuster 4.9% growth rate in Q3 that we have seen in the US, we do expect the US growth rate to come down well below 2% for the last quarter of this year, and then below 1% at the beginning of next year. And as a result of this expected slowdown, it kind of feeds into our view of the US central bank starting to cut rates already in the first half of next year. So markets are currently pricing in the first cuts, the first easing of monetary policy to be done at the September meeting next year. We think, given our more cautious view on the US economy and expecting US inflation to fall a bit more quicker than is currently priced in, this is why we are calling for a much sooner easing of monetary policy in the US. But still, markets are, even though they have postponed the first rate cut, from June to September next year, they're still seeing rate cuts worth around 100 basis points for the whole of 2024. In Europe, on the next slide, it looks quite a lot of different, because Europe in its nature is pro-cyclical, and these interest rates have, not only the interest rates, but also the global trade recession and also the Chinese slowdown. All these factors have had a much significantly stronger, but also a more direct impact on Europe than, for example, on the US. And not only are the ECB's rate hikes worth 450 basis points pushing down the economy, but also the interest rates of the other central banks, given that the European economy is dependent on exporting its goods to all the nations, meaning that if global growth weakens, this also impacts European exports and European GDP. We can say that European or Eurozone GDP is still 4% above its pre-pandemic level, which is normally a good thing, but it is still trailing China, for example, which is a surplus of 32% in real terms. And the US economy is also 10% stronger than it was pre-pandemic. So the 4% of the Eurozone have to be put into perspective here. And we can also see that the recent pullback from the consumer and also from the manufacturing side has left both retail sales and industrial production to return back to their pre-pandemic levels, which kind of highlights for us the difficulties of really sustaining robust growth rates when interest rates on the short end are at 20 or 25-year highs. And yet, we have to say that we are still expecting a slight economic rebound in 2024. It is maybe hard to explain on the surface, but going into it, we are expecting inflation and interest rates to have peaked this year, right? And the parts of the real economy that have really suffered from this tightening monetary policy that I've talked about, the pro-cyclical sectors, manufacturing, global trade, the property market, these that have suffered first are most likely to be the first ones to benefit from the expected easing of policy in 2024. And we are already seeing some slight increase of momentum in global trade, looking at Chinese exports numbers, looking at South Korea as a leading indicator on this matter. And we do expect this recovery to continue into next year. So this is kind of the bright note. I still have to, again, caution our view on Europe at this point, because we see this slight rebound not really as a recovery, but more of a technical move. The only argument for betting on Europe in this case versus the US is that the economic weakness that we have seen has really been front-loaded in the UK and in Europe because of how quickly the economies have felt the impact of higher interest rates and the global trade recession. But there still remains relatively few positive catalysts for a strong economic rebound. For Germany, for example, if we look at the latest numbers that have come out, we do expect the German economy to be negative in 2024 as in general, after the negative print in Q3, excuse me. We're also predicting a negative print for Q4. Looking at 2024, we see economic growth at around 0.3% on real terms, which is positive, which is a good note, but it's still well below the 10-year trend before the pandemic. And the last data points that we have got from the last 3 or 4 months are also not really indicating a bottoming of the German economy. Looking, for example, at unemployment figures, they have been rising for 9 consecutive months. Industrial production is still a full 17% below its pre-pandemic trend, and bankruptcies have been rising by 44% in September compared to the previous level. So we can see that this hope for a rebound are definitely not well placed. We are expecting stronger growth in 2024 compared to this year, but just again, because most of the economic weakness has been front-loaded into this year. And this is not the case for the US, where most of the weakness will probably only come at the beginning of next year. But yeah, these are our outlooks on the economies. Maybe one last thing to note here. We are not really expecting an energy crunch in Europe in winter, which is normally a really good thing, especially after the disruptions we have had the last previous winters. Because although electricity production is mostly down in Europe, and in Germany in particular, I think down 11% compared to its previous year, the decline is initially being well compensated for by other countries. For example, France stepping up its electricity production, and gas reserves in Europe in general are also fully filled at 100%. Nevertheless, sentiment remains quite weak in Europe, and looking at the surveys, the PMIs, the German business confidence, we can see that both business and consumer confidence remains really depressed. And in our models, as I said, we don't expect a winter crunch, but we are seeing the inflation in Europe going back to 2% next year. And this feeds or strengthens our call for the ECB cutting rates first in the G3 space at around May or April next year. So yeah, this is how it would look like for the US and Europe. And George, I think, can give us a better outlook on how our views on the US and on Europe translate into our call for EUR/USD for 2024.
Yeah, thanks again, Boris. Plenty of valuable insight there as always, helping us to try and decipher how this might impact exchange rates in the future, the euro-dollar exchange rate, what we're looking at the moment. And everything that's Boris has mentioned so far is why our euro-dollar forecast for next year has dampened slightly, but we still expect this sort of modest recovery going into next year. Now, if you've been on our webinars in the past, you'll know that at Convera, we believe in taking a scenario-based approach when it comes to this, a bit more appropriate to understand the effects of various plausible events. But as a research team, we do, of course, form our own opinions based on particular assumptions. And we do believe that euro-dollar should recover modestly going into next year, simply because much of the economic weakness is already sort of priced into the Eurozone and the euro, and not the US. And whilst we haven't seen the bottoming of Europe so far, as Boris mentioned, we're certainly nearer to peak pessimism here compared to in the US, where we're nearer to peak US optimism, which really makes the euro-dollar pair more vulnerable to upside risks as opposed to downside risks, in our opinion. Of course, assuming there's no unforeseen shocks that rattle markets. And this view as well is compounded by the fact that the dollar has risen significantly since the pandemic. Therefore, positioning is more in favor of the euro, in favor of the euro as well. But again, we need to consider the limitations and the downside risks to our base case. You know, due to the geopolitical risks and the assumption that the ECB is going to cut its key interest rate again before the Fed, the upside potential is probably going to be limited, and turning structurally bullish or positive on the euro, and to see that the euro-dollar pair break into the teens. It's going to also require a big uptick in the Chinese business cycle as well, because we note that in all 4 periods of euro strength and multi-year highs that the euro has made against the dollar from 2010 to 2021, they've all occurred while the Chinese manufacturing sector has been expanding, which makes sense given the trade relations between Europe and China. Currently, as we know, that's not the case, so we will need that to make a U-turn for next year as well. But again, to reiterate our point, that Boris's point earlier, we do expect global economic momentum to remain subdued going into next year, and this weak growth environment is therefore likely to limit the euro's potential upside. From a more technical standpoint, the exchange rate as it stands is around, or is just down year to date, in fact, sitting in the middle of its 1 and 2 year averages. Over the past couple of years prior, the pair's fallen 6% and 7% respectively. So its current position down on the year it could pose a risk if we do record a third consecutive yearly decline. But given looking at some seasonality studies, looking at Eurozone data, which usually surprises to the upside this time of year, and the Euro does usually perform well into year end, the fact that we're at this sort of steady point at this time of the year could be fruitful for the Euro. If it does record its first positive year since 2020, that might be the springboard needed going into next year for this upside that we're expecting. Now, before I move on, just a reminder that we can produce these forecast scenarios for many currency pairs. So although we're not presenting a lot of different currency pairs today, you can find more in the full Are You Ready report as well. But also, if you want any more outside of what you see in the report, you can reach out to us at the contact at the end of this presentation deck. So we've discussed Europe, we've discussed the US. Now I'm going to talk through the UK outlook, and then we'll look at the sterling dollar forecast scenarios. So firstly here, the UK outlook. If you remember this time last year, everyone was talking about a lengthy UK recession, and we've got to hold our hands up as well. Our Are You Ready report for this year, Are You Ready for 2023, was actually talking about that lengthy UK recession that was expected. The Bank of England was probably the most pessimistic, talking about a 15-month-long recession. Obviously, these fears were overblown. Instead, the UK economy has actually grown for 9 quarters in a row. And that's helped by the low unemployment that we've had, the excess savings that was built up during the pandemic, and consumer spending being way more resilient than expected in the face of rising interest rates so far. And since the start of the pandemic, the UK has actually put in a reasonable growth performance relative to other major economies, but a bit of a poor one on inflation, as we know. So some evidence of this as of Q2, as of the second quarter this year, UK GDP was just over 2% larger than the average level in 2019. And this is bigger than Germany, France, Italy, Japan as well, but smaller than that of Canada and the US. Conversely, the inflation story on a pre-COVID comparison, as I say, the UK has put in the worst performance on inflation in the G7, with UK consumer prices in the third quarter of this year almost 22% higher than the 2019 average. We have seen headline inflation in the UK fall from that 11% peak that we had in around October last year, to around 6.7% was the last print that we had. Currently, 50% of the CPI basket is actually below the Bank of England's 2% target, but a fifth of those components still remain over 8%. As I said, the headline print of 6.7% overall is still very a lot higher than what the Bank of England would like, and it's also a lot higher than the G7 economies. Core inflation as well hasn't rolled over as quickly either, due to the pass-through of strong services wage inflation. And this has been a key story, or a key theme in the UK for this year, because inflation pressures have been reflected in wage growth, as well, as I'll discuss in more detail shortly. But real wage growth has turned positive this year, as you can see on this chart via the darker shaded bubbles at the top there, to the right of that line of identity on the chart. But I'll mention the size of the bubbles on this chart as well. They also matter. They reflect the number of unfilled job vacancies. So the larger the bubble, the more unfilled job vacancies there. And although vacancies have fallen, they've fallen for about 14 or 15 consecutive months now in a sign of a looser labour market conditions. The vacancies to unemployment ratio still remains more than 2 standard deviations above the 2002 to 2019 average. So certainly the labour market constraints that we've had in the UK appear to be more marked than elsewhere. Because, for example, the UK workforce has fallen by more relative to past trends than other G7 economies. And that's supposedly linked to a surge in numbers of those in long-term sickness, for example. But we do have to point out here that recently it's come to light the reliability of this labour market data has come under some scrutiny just due to the huge reduction in the sample size of those surveys used. But still, what we got to assume and from the information that we have is that the UK has had an unusually tight jobs market by international standards, and that's held back the UK economy's growth potential, but it's also resulted in unusually strong pay growth by international standards as well. As I mentioned earlier, as a comparison, for example, in the second quarter of this year, average UK wages were up over 8% on a year earlier versus the rises that we saw of 4% and 5% in the US and Germany and France. So with that, firms passing on higher wages into prices, it's probably contributed to the UK's relatively high inflation rate. Of course, comparatively large rises in energy costs as well. That's helped to drive UK inflation up by more than that of the US, for example. But as Boris mentioned, energy prices have come down very sharply from where they were last year. We've also seen food prices come down to the lowest in a year. Producer prices and import prices are in deflation. So we do expect these easing price pressures to continue feeding into consumer prices. And we've got some leading indicators from business surveys of selling price expectations that correlate highly with CPI that point towards inflation falling to below 5% before the end of this year. And that's in line with the Bank of England's forecast as well. So the narrative seems to be slowly but surely shifting from these inflation concerns towards the economic slowdown, stagflation or stagnation and recession fears as well. And that's why markets are pricing in interest rate cuts by the Bank of England next year, are currently amounted to 75 basis points. So from where we are today, the bank rate is at 5.25% now. 75 basis points of cuts would take that to 4.5%. And it's this repricing that we've seen that has hurt the pound over the second half of this year. I mean, around the summertime in July, markets are pricing in a peak bank rate of 6.5%. And that's when the pound hit its peak against the US dollar at around 131. That's when yield spreads between the UK and the US were the highest since 2014, driving that sterling dollar exchange rate to those highs. But since then, we have seen economic activity in the UK weakening. The services sector, that's been in contraction for 5 months running now. The manufacturing sector, that's been in contraction for the longest period since 2008. And we've seen revisions to GDP growth for next year to zero by the Bank of England. So the prospects of interest rate cuts have increased as a result of all of this, and it's dented the attractiveness of the pound. And we're also really conscious of the fact that economic growth is likely to be impacted by other uncertainties, including the lagged impact of monetary policy tightening. And one of them, as an example, in the UK is the housing market. Nearly 7 million fixed rate mortgages that there are. Of these, 1.6 million deals are ending next year. So they'll have to be refinanced at much higher rates, of course. So we do expect that despite these easing price pressures in relation to inflation falling, the lagged effect of higher interest rates is yet to fully impact or feed through to the UK economy and consumer. And that could weigh on consumer confidence and spending going forward, which is something to bear in mind for next year as well. So how does this translate to the pound's outlook? Well, much like the euro versus the US dollar, the euro dollar exchange rate, much like that, the sterling dollar exchange rate or the pound's fortunes might actually mainly depend on what happens in the US. So although the UK outlook is rather bleak, if we do continue to see US data disappointing and the US outlook deteriorating, then this, in our view, is going to hurt the dollar more than weak UK data hurting the pound. And we saw evidence of this from last week. It was a massive week in markets, a massive week in the pound, because the sterling dollar exchange rate staged its best week of the year, rising over 2% and recording its second biggest daily rise on the year on Friday after the US non-farm payrolls print disappointed, which goes to show just how vulnerable the dollar is to these negative US data releases. And if we see more of them, then we see that the dollar is going to be punished more. We've actually broken out, because of that big move, we've broken out of that descending trend channel that we've been in since hitting that peak in July. So this kind of fits our narrative, again, assuming no major shocks, that the sterling dollar exchange rate may begin to on the shallow recovery going into 2022, but it's obviously not going to be a smooth journey. Of course, we do expect volatile price action as data comes in, because data is going to be highly important as usual. It's going to impact policy decisions and therefore rate pricing in markets, and that was going to remain a key driver of trends in exchange rates going into next year as well. And our base case, though, as you can see, is for that mild recovery in the sterling dollar exchange rate. But again, we provide this scenario-based approach just to make sure that businesses are aware of the upside and downside risk to the base case. And the downside risk is, of course, a deeper UK recession that forces the Bank of England to cut interest rates more than markets are currently pricing in. And we also can't forget that the recessions aren't good for global risk appetite. As Boris mentioned, equities would start to probably fall in the case of the US recession. It doesn't bode well for the pound because it has a very high positive, or the highest positive correlation with global stock indices out of the major currencies. So there could be a period of downside risk to the pound in the event of that happening. But from a more technical aspect, the currency pair as it stands today, around 122, 123, is about 25% below its average rate of the 21st century. It's also 4% below its 5-year average. So again, looking at where the pound's positioned, it is undervalued, and therefore it gives us some confidence in its ability, or more of a justification for its potential to strengthen from the current levels that it stands at the moment. But again, we think for the pound to gain real momentum in this high interest rate environment as it is, the UK economic growth is going to have to remain relatively resilient as well. Alternatively, a high interest rate but low growth environment is probably going to limit the pound's appreciation, and that we've got to be aware of that. And again, this relates back to what we said about turning structurally bullish or positive on the euro, in that we need to help with the global economic recovery, the Chinese manufacturing sector to pick up into expansion territory as well. As I mentioned before, with the euro and its multi-year highs, the same sort of theory applies to the pound. The same correlation applies in terms of whether or when we're going to see those multi-year highs for sterling dollar unfold again. But as ever, the main takeaway here is that it's imperative to consider a range of scenarios, making sure that as a business, you're sufficiently positioned to take advantage of favorable moves in the market, as well as being sufficiently positioned or protected in the event of any adverse moves in the market, which, as we know, can happen, and they can happen out of the blue. And that leads us on to the final section of the webinar here, which is FX risk management trends. Because all of these thoughts and assumptions that we discussed today and discuss in our Are You Ready for 2024 report, they flow into our foreign exchange risk management solutions. Because as a business, Convera has seen an uptick in customers seeking support to mitigate currency risk, as we can see via our internal data, and that's showing an increase in hedging transactions over the past couple of years, in particular the past couple of years anyway, as you can see on the chart here. And we think it's the increase in market volatility that we've witnessed, especially since the pandemic, and then more recently with inflation spiking and interest rates rising as they have, that's obviously been impacting cash flow negatively and squeezing profit margins. And that's led to this increased demand for FX hedging. And we expect this to probably resume or continue in 2024 as companies try and attempt to future-proof payments and their profit margins. I won't go into detail here, as Boris and I, we're really mainly on the research side of things. But if you are interested to learn more about our many solutions on offer, then please do reach out to your point of contact at Convera for more details. Protecting against currency volatility, for example, diversifying into alternative markets, or you can talk to us about automated global payment solutions, compliance controls, fraud prevention measures, and even our ESG capabilities as well. But if you have any questions or concerns regarding the material today, or as I mentioned earlier, any more forecasts on currency pairs or even country outlooks, please feel free to contact me and my team via the email at the end of the presentation deck that I'll share shortly. But that's it from the presentation today. Thank you for everyone for sticking with us so far. I appreciate there's a lot of content to have digested here, but we have got some time left dedicated for Q&A now. So if you do want to submit a question, please use the control panel. Boris and I will try and get through as many as possible. Boris, I think you probably had some time to review any that we've had come in so far, so I'll hand over to you for this section to kick it off.
Yeah, thanks, George. One question that has come up that it's the same question we have had in our APEC webinar earlier today. It's regarding our views on China, because China has been brought up quite a lot during the presentation. It comes up quite a lot in our written report, but we didn't really have the time to really delve into the topic. So just to kind of give a broad summary of what our views are on China. We know that this promised Chinese reopening from its almost 2-year lockdown policy has so far really disappointed investors, because economic growth will for this year probably be around 5%, and we're expecting Chinese growth to be sub 5% going into 2024, which normally every developed country would be satisfied with such a growth rate. But for China, looking at its historic growth rate, especially pre-pandemic, this is really something that is not that good for them. And it is because while we, as I said, do expect these worries or uncertainties surrounding manufacturing and global trade to ease a bit going into next year, we do see these structural factors dampen the optimism surrounding China. And if you look at, for example, the latest data point we have had just before our first webinar today, it showed that Chinese inflation once again fell into negative territory, which again highlights just how hard it is to put up economic growth when interest rates are that high. And survey data has also suggested the same. We had the Purchasing Manager Index for manufacturing released last month, which showed that Chinese manufacturing is once again in recessionary territory. And the PBOC, the central bank, has tried to uplift momentum. They have tried to ease policy a bit, which is why we didn't go into our US dollar one pair, but it is a reason for why the interest rate differential between the US and China and between Europe and China is at the highest level since the global financial crisis. But it still wasn't enough. These couple of rate cuts weren't really enough in China to strengthen the economy to such an extent that we would see an economic uplift. And this is why investors have really not been convinced about this growth story in China. If you looked at the Shanghai Composite Index, the Chinese equity benchmark, it is down around 10% since May. And because of the crackdown on the tech industry domestically in China, the famous Golden Dragon Index that is published by the NASDAQ is down 70% from its peak reached in 2021. So it seems sentiment is really weak. And the only thing, a bit similar to Europe as well, the only thing China has going for itself right now, looking at 2024, is the fact that sentiment is as depressed as it is right now, meaning that the potential for surprises is actually on the upside and not on the downside. And if China surprises, as you said, there's a large correlation between how China performs and how risk assets like global equities and risk-prone currencies like, for example, the euro, the Aussie dollar, and the British pound perform. So a really strong bullish call or take on the euro and the pound would have to be met with China outperforming expectations. I think this summarizes our view on China for 2024.
Awesome, thanks, Boris. We've got one question around downloading the full report. It should be, if you have on your control panel, there's a link to resources, and in resources, I think there's 3 more tabs below that, and it should be under the link tab. So if you can't see that, then just email us after and we can send you that link. Another question in relation to the UK, the mortgage rate increases and how if and when that will start impacting the UK economy. Well, arguably it already has. I mean, historically, the UK economy or mortgage rates haven't been fixed. I mean, over the last decade or so, the proportion of UK mortgages on fixed rates has increased significantly. So therefore, the fact that the interest rates have increased significantly since the end of 2021 means that those fixed rates will come due to a lot of those will be due to be refinanced over the next couple of years. So the delayed impact, really, as I mentioned, we've got nearly 2 million that need to be refinanced next year and even more in 2025. So in terms of the impact, it still could be delayed, but it may not be as severe as what quite a few people are predicting. I mean, the UK is a consumer-driven economy, and obviously, if those higher rates start to squeeze household incomes, and that's the theory behind it. But equally, as I mentioned, the real wage story is improving. Inflation's falling, wage growth has increased significantly compared to G7 nations. So, so let's not forget, while the jobs market is cooling, the aggregate impact on consumer spending might not be as great as we fear. A lot of this is going to hinge on whether the deterioration in hiring conditions accelerates over the coming months, whether or not that translates into hurting the UK economy. It remains to be seen, but that's sort of the way up between the mortgage rate increases and the upside being that the real wage growth has improved in the UK.
Awesome, George. Maybe one last question, if we got some time.
Yeah.
There's a question regarding maybe looking at a black swan events for 2024. I think it's quite an interesting one from a market's perspective, because black swan events are defined by not being able to predict them beforehand. But we have a theme that kind of dwells into the political elections that are coming up in 2024, which we didn't have time to mention during the presentation. So we think that there are a couple of elections coming up that are definitely having the potential to shape financial markets. The first one in general are the regional parliamentary elections in Germany, where the right-wing AfD party has started gaining a bit more traction. Then we have the European parliamentary election that is also probably be a ground for debates around Europe's industrial future, Europe's relationship with China and the US, and so on. But one thing that will really be highlighted at the end of next year will be the US election, where Donald Trump is still the candidate with, looking at the polling, and the most popularity. And we can look at the 2016 election, where Donald Trump won the presidential election for the first time, how it really impacted financial markets in a negative way, and especially the Euro-USD currency pair, because it took a couple of months for the euro to recover, regain its strength that it's lost during and after the election in 2016. So it's not really about individual elections, it's more about all these elections shaping up to a broader narrative, which is geopolitical tensions and kind of this reshaping of the international order, which, as we heard in all the surveys, internal and external, are definitely something that companies are aware of and are starting to incorporate into their planning for the next year.
Brilliant. Thanks a lot, Boris. And thanks again to everyone for the questions. I'm going to respect the time and then the Q&A there, and just make a few final remarks before ending today's session. Firstly, whatever email address you use to register for the webinar, you'll automatically receive the recording from Currency Convo, so do look out for that. I've been informed that the link to the full report wasn't able to access it in the resources tab, so you should see it in the webinar chat, a link to it in the webinar chat in the control panel right now. But if not, we'll make sure that it's sent out to you with the recording. You can contact us as I mentioned earlier, via the details on this page here. If you've got any questions related to any of the material, or you want any more forecasts, as I mentioned earlier, or of course you can reach out to your account manager at Convera, and they can reach out to us via that way. But thanks again to you, Boris, and thank you to everyone for joining us today. Wishing you all the best for the future. Good luck.